Hello, and welcome back to another episode of your favorite podcast. This is the Lone Star Capital Podcast. Your host, as always, Craig McGrouther, the Director of Business Development here at Lone Star Capital, alongside the one, the only, Mr. Suit Supply himself, with a paddock on the wrist today as well, Mr. Patek Philippe, Rob Beardsley, in Dallas, Texas, correct?
That's correct. Yes, I'm here at the Ritz-Carlton. I'm actually currently attending the Newmark National Housing invite only top client summit. So definitely exciting to be here and be surrounded by high quality people that are also making things happen in the multifamily space.
Yeah, you lunched at George Bush, right?
That's tomorrow.
No, got it. Yes, very good. Well, we were just in Dallas, and we're going to go through all of that. But before we do get into the meat and potatoes of the show, we've got some housekeeping for you. So, you're watching this today, we are live with our latest acquisition. Yes, we are live with our latest acquisition, Gran Riviera, an incredible 206-unit multifamily opportunity in Irving, very close to Las Colinas, very close to DFW, the fourth busiest airport in the nation. So, with that said, if you are a capital allocator, if you have a 1031 exchange coming up, if you're an LP investor looking for an amazing 506C opportunity, we are your guys. Reach out to me, Craig at lscre.com. Yes, once more, that is Craig at lscre.com. You know the email, but I had to hit it with you again, just in case you forgot to spell my name and Lone Star Capital's acronym. Craig at lscre.com for that right there. Also, not only do we have our incredible deal that we have, but we also are hosting our special summit, the fourth iteration, if I'm not mistaken, on September 16th and 15th and 16th. We're kind of cutting it down, more grandiose of a pre-party, but a more meaty first day of the conference. So we're absolutely thrilled for that one. This will be a star-studded affair and lineup of some of the best in the business. And we're actually opening this up to a little bit larger of a group than the years before. We don't want this just to be a solo Lone Star ad, although we do love those. And if you want to keep pumping out some ads for us, we welcome all compliments and flattery. But with that said, we are hosting our conference those 2 days in New York City. We want this to be the best commercial real estate event. So if you're an industrial real estate operator, if you're in multifamily, probably not in Texas, but in the Southeast, in the West Coast, reach out to us. If you're in self-storage, you name it, we want you there. We want to introduce you to our LPs. We want to introduce you to our network and ecosystem of boutique capital raisers, our LPs and investors, and of course our institutional equity connections, the family offices that we work with. So please, if you're interested at all in being part of one of the best real estate conferences in Manhattan in the One World Trade Center, meeting everyone here and part of our network, please let me know.
And what I'll add to that, good. That's a nice.
We're fired up right now.
Yeah. That was a really nice housekeeping there. So what I will add is applications have been trickling in for the Lone Star Summit this year, and high quality people. There's people that there was a family office, Southern California based family office that has been an LP for 30 years. That's, I guess, looking to get into the GP world. They applied to attend the summit, and they are buying a $30 million deal, all cash right now. There's another quality group in the Midwest that has submitted their application. So, yeah, it's exciting to see the quality sponsorship that is looking to join us. And then, of course, that will be matched with the very robust and quality network of LPs that we'll be bringing to the event as well. So that matchmaking will be happening, and it's highly curated, highly intimate. Everyone leaves feeling like they made genuine connections. So yeah, looking forward to it again this year.
Yeah, the purpose of this is to not listen to a bunch of content. The purpose of the show is of this event, I should say, is to truly network, mingle with some of the best in the space, and leave this conference knowing that you have someone that you may do business with at some point. And I'm just going to say this right now. I think what I've really found to this point, my short tenure just in the private equity space, is you can send people cold emails, and there's a chance it goes through. But the people that I have the most success with, the people that I've been able to network with best, that respond to our deals best, are the folks that we meet with and actually have a frame of reference of, I met this person here, they're a real person, I know who they are. And I think you're going to accomplish that and get a lot of value out of this event. It's not the cheapest event, but usually the ticket price is a very big indication of the value of the conference, and you'll be well fed, well smoked, because we have Cigar Bar, Barclay Rex, Reserve Cut, the whole nine. It's going to be really wonderful. So we hope to see you there. Feel free to reach out to myself, you know it, and we'll take care of you. So yeah, once more, we got that going on. Feel free to reach out there. And also, just generally speaking, we want to meet with every capital allocator and LP that we have. So if you listen to the show and you've not met us yet and looking to connect, let us know where you live, where you're at, and we will try to pull up to you because we're kind of the traveling circus. We kind of go to every city in this nation due to all the conferences we're going to. So yeah, thank you so much for listening to that spiel there. On to the show now. Well, do you want to start with the fact that you're in Dallas? Do we want to recap our trip, or do we want to go right into Gran Riviera?
Let's do a recap trip. And how about we start with the fact that I may be wearing a Patek Philippe, but you're wearing the brand new. No. You're wearing the brand new pink Masters shirt.
Dude, hey, people aren't talking about this enough. Let's just get in the full, kind of feel here. Okay.
You look like a Texas multifamily broker.
Dude, I know. Only difference is I'm not married with kids yet. But that said, I'm going to give a shout out to Barrett Oakley. He gave me this sweet shirt. I feel like I could raise a bunch of equity and go low in this shirt today. So maybe that's why I'm so jazzed up right now.
So isn't it weird? I thought that sponsors usually give investors gifts. Why are investors giving us gifts?
I don't know. I guess we are those boys. But God, I love Barrett. He's the man. And I feel so grateful for all the partners that we have. And we need to do a retreat of sorts at the Family Casa, the vacation place in Oregon, to truly take care of some of our best people, our favorite people. Go out there, play some golf, take care of them, enrich our lives and relationships with them. But yeah, this jacket here is amazing. We got the back girl on, which I got a very nice compliment on at the airport yesterday. You, of course, are wearing the courtesy Suit Supply sport coat there. Why don't you give them a little flavor of what's going on?
Well, yeah, I'm not in the suit and tie today because I'm in Texas. It's 95 degrees outside. It's the Newmark client event, and everyone's here in their typical broker gear. They've got their navy coat on, they've got their gray trousers on, and then they've got some sort of ugly crossover sneaker / dress shoe. So,
the Atrocity 2s?
Yeah, the Atrocity 2.0s. I've got to come and show people that, hey, there's a nice way to dress, and you don't have to be in a suit and tie to be nicely dressed. You can still have a bit of flair. So thought I'd do a little bit of a casual polo mixed in with the sport coat, just to mix it up. Summertime.
As one does. Well, no, Dallas was a very good trip. It's highly productive. We met with some equity partners that were really intentional about wanting to meet up with us. So that was really special to have them connect with us. And then we also had a really fun time at Gran Riviera because we like to obviously always have a promotional video to really convey the property and the business plan there and the story. So why don't you kind of dig into that experience you had?
Yeah, so first order of business when we got to Dallas was for us to go to Gran Riviera, our latest acquisition, which we'll break down some of the highlights here shortly, and also peel back the curtain and show you kind of behind the scenes of our acquisitions process. So Monday morning, first thing, we went over to Gran Riviera and we set up shop to record a video on site. And we've been kind of testing different iterations of a property tour video or a property promo highlight video. And what we've noticed is that this is not going to be news to anybody, but people have short attention spans. And so instead of doing a 30-minute robust walkthrough video, which people may or may not really pay attention to, and frankly, we can tell you the answer. We have the viewing data. The data on YouTube shows that people only really tune in for about 6 minutes of it. So the reality is we are moving forward going to be creating more of like a condensed hype video that really just gives you a feeling. You can look at the pitch deck, you can tune into our webinar, but us being on site and seeing the camera work of the drone footage, etc., you don't need 30 minutes of that. You just need to get 5 minutes to get the feeling of the property, which is what we aim to convey. So, and this was actually a bit of I don't want to say a wake-up call, but when we were recording, we have an amazing video team, Weston and Chris, from Exclusive Productions, and they do a fantastic job. They make anything look like a movie, right? They can make multifamily look like a Hollywood, right? Super exciting.
Yeah, they can make it look like a Tom Cruise featured film.
So we're kind of walking through our script and we're hitting the highlights, right? We're talking about the location. We're talking about the story of how we got the deal. We're talking about the debt, with the business plan. And then Weston just kind of stopped us and said, guys, this is all good information, but this is a hype video. I need to hear from you why you are buying this deal. Why do you want to invest in this deal? And that kind of hit me and made me realize, okay, yeah, you're right. I'm pretty bad at marketing. And the reality is we need to show a little more hype. We need to be more concise. And so boiling Gran Riviera down, just so I can kind of give it a little practice here and let everybody know why we're so excited about the deal and why I'm personally investing my money into the deal.
What a segue.
Yeah. So the three reasons for why we love this deal and why we're investing in this deal is first the location. And I think that is generally true when you talk about Dallas, because yes, there's some bad pockets about Dallas, but there's so many good pockets of Dallas that just kind of like overwhelm you and win you over, and that you just have to invest here. And Gran Riviera is a 1972 vintage deal, 206 units in Irving, nestled between DFW and Las Colinas. So for those that are familiar with DFW, you'll know that that is a really strong pocket, but it's more than just a strong pocket. There's so many other features that I think just kind of perfectly put this deal right in our buy box. First of all, it's an older asset, but it has good bones. It has pitched roofs. It has individual HVAC, copper wiring, PVC plumbing. So we're very well budgeted and accounted for on the deferred maintenance side. And I like, in this case, buying an older property because it keeps us more insulated from new supply. If we were to go east over to Las Colinas, where people make more money, right, and there's more kind of density of jobs, well, there's also an overwhelming amount of new supply. And that's something I don't really want to play with. It's a bit scarier, and it will likely mean softer rents and softer collections and more concessions over the next about 2 years, because supply needs to run through for the next couple of years.
Yeah, and that's such an interesting concept you hit on right there, which is, if you do buy in the hottest area, in the hottest pocket, and you buy, newer, better assets, you're going to be constantly competing with, new supply, which is totally fine. We're buying deals like that. I think generally speaking, we're looking to buy suburban multifamily, garden style, assets, maybe podium style, of course, as well. But by and large, it is, kind of suburban, garden style multifamily, right? And if you do go into the highest growth areas, you're probably going to be in areas that are being rezoned, redeveloped, and there's just always a constant flurry and flood of new opportunities coming up. It's the latest and greatest that has the newest sizzle and steak feel to it, right? But when you go to an opportunity like this, there's a nice spread that can be collected and a clear path to value creation. And we found an opportunity that, really is there in the market cycle, right? So we're not really competing with new supply. And, I think a big thing that we've had to address is some people are going to naturally discard the fact that this deal is a 1972 vintage opportunity. But this deal, and when we walked through it, I didn't really notice the difference between this deal as opposed to, let's say, a Spire apartment complex, which we closed, obviously, in January, right? That deal was a 1986 deal, but that deal did not feel different at all. Actually, I would argue all day long that this deal had a way better just, outside aesthetic feel than this opportunity. Or this opportunity had a way better kind of feel than that deal. The ceilings, I believe, were a little bit higher. The floor plans were substantially bigger. The property itself was large. It had very nice frontage as well. Obviously, being on Bandera Road is a massive benefit that, of course, Aspire Apartments had. This opportunity, though, was really well appointed. Gets a lot of car traffic. You could clearly tell there. And it just felt like there was a very clear path and kind of a tired feel to it. And you can fix a tired feel to it, And it definitely felt like there was as I said, a clear path to creating, value here. And I'd love for you to kind of walk through just a little bit more fundamentally speaking about, kind of the moat we get in a supply perspective when you do actually buy a 70s or 80s asset as opposed to, buying something that's in the 2000s.
Yeah, you mentioned a lot of good points. So a couple things to circle back on. Firstly, the supply discussion. Within a 2-mile radius of the asset, there is no new supply, right? And that speaks to the point that if you are in a more workforce location where incomes are lower, not saying they have to be really low and that crime has to be high, but if you're just away from the 100K plus incomes, there's going to be just a general supply mode. And that is apparent here. Yet we're also, just to kind of round out the location discussion, if you go west, DFW Airport, 4th busiest airport in the world, got a new terminal under construction, a new American Airlines headquarters under construction. So it's just a story of jobs. But another thing you mentioned that was really important was the size of the units. And so these are all kind of the things that you need to look at under the hood. You can't just look at, okay, well, this is a 200 unit deal. It's a 70s vintage asset, and this is the location, and this is the median household income. Done.
This is the exterior. This is the paint,
You have to look at these specifics because you've got to attack deal flow with a fine-tooth comb because the market is so competitive. You've got to find the nuances and you have to find the unique value that people may be overlooking. And I think you nailed it on this one where there's definitely buyers out there who looked at this thing and they scanned it and they said, oh, 72 vintage, that's a pass. But if you really dig in and you look at it, this deal just feels like an 80s deal. And conversely, I'm not going to name any names, but I toured a property this morning here in Dallas, and it's a 97 vintage asset. And I'll tell you, aside from being 9-foot ceilings, it feels completely unremarkable and it feels like an 80s deal. But institutional capital is going to be all over this deal simply for the fact that it was built in 1997. So that speaks to kind of people just looking at things at a high level and not drilling in. So I think this 97 vintage deal, I think there's some good things about it, and I think it very well could be a great deal. So don't come after us if we end up buying it. But let me just finish this out. I do think this 97 deal will attract an unwarranted premium a little bit for the vintage, aside from the fact that it's 9-foot ceilings. That's one of the biggest differentiators, or I'd argue the biggest differentiator when it comes to 80s construction versus 90s is the 9-foot ceiling factor. And there is even some rare instances of 80s construction having 9-foot ceilings.
I love conversations like this because now we're really getting the nitty gritty. And I actually have a very good question for you. So one thing I really like about Gran Riviera as well is what we're fixing is the cosmetic side of things. So you're going to hear this tons of times when we talk about this deal, but we've got pitched roofs, okay, not flat roofs, pitched roofs. We've got PVC plumbing, which is, basically if you were to build a house today, which I'll be doing soon with improvements to my house, that'll be another episode later. PVC plumbing is probably what you'd put into it. And then copper wiring, which is what you want to put in everywhere, right? Those are three very, very crucial items that 70s properties, typically speaking, don't have, or have some deferred maintenance items, whether it be, galvanized plumbing or, some sort of issue pertaining to, just more, antiquated, building practices and kind of leftover unsexy CapEx expenditure things you have to fix. There's no stab walks on this property. And then also every property or every unit has individual HVAC. So these are really, really special items. But my question to you would be, regardless if the seller fixed this or not, if they were to sell this deal in the marketplace without those items or with it, would there be any difference in the price someone would get for the property here? Because we're able to come in here not have to clean up a bunch of items, but we're just kind of doing the cosmetic stuff, the deferred maintenance items, painting, interiors, backsplash, the whole nine. You've seen the before and after, the fun pictures, but I feel like we're getting a really nice premium because we don't have to remediate these old issues, but we're basically buying it at a point where if you bought a similar deal without that fix, you'd have to pay the same price. But that's obviously a very expensive expense item you'd get there otherwise.
Yeah, I think that's partially true, but we are also going in with a very heavy CapEx budget because we don't want any surprises. So we are going in and preemptively making roof repairs, and we are fixing up the foundation. So we actually are doing some heavy lifting. So it's not, I have to disagree. I think we are actually doing a bit more here than just simple cosmetic. I think we are rolling up our sleeves and doing some of the behind the scenes work that is not as seen, but extremely valuable, because what the type of market that we're in right now is people in some sense have the luxury of being a bit more picky today because they are looking at the market and prices are down and the market is a bit more of a buyer's market than before. And so buyers have the luxury of picking and choosing. But when the market gets hot again, which of course the markets always will get hot again.
And believe me, in Dallas, it will.
Oh, yeah.
And it already is hot, which is, another story, obviously.
It's a bit of a head scratcher. But when the market does get hot again, that's when people stop really being so discerning between vintage and between exactly the condition of a property. They're kind of willing to take on a older asset, if you will. So this deal will position, like right now, I think we're buying it at a nice basis, a good discount, and then it'll be positioned to trade really well. And I think that fits really nicely. And it's kind of the overall business plan of going in there and just doing a lot of work and really transforming this asset to capture the straightforward rent premium is a business plan that we haven't done in a while because we haven't found opportunities that we thought really made sense in this way. But here it certainly does.
Yeah, and I think there's a theme here that we've kind of discussed several times, so I'll just hit it, real quick. No need to belabor it anymore. But just we're at the point of the cycle where so many deals have been turned over and value added and improved. This opportunity has, over 150 units that need to get turned over that original, and about 50 partially renovated units that need to be fixed. So that's interesting there. Another thing that you kind of mentioned that I find to be super fascinating is just the rent pricing and difference and kind of the premiums that we're getting for ones, twos, and threes, kind of all across the board. This is internal information we have from our portfolio, and obviously from all the data, like from Axios, from Yardi, from CoStar, also suggesting this remains true. But can you kind of touch on, the differences in renting and maybe the increases that we're getting in twos and threes juxtaposed to one bedrooms, please?
Yeah, right now we're seeing a softer rental market. Rents are moderating in stronger pockets in Texas. Rents are still positive, but they're not growing like the way they used to. And so with a softer rental market, you're seeing, especially with new product, you're seeing concessions, and like new projects that are delivering, the concessions on their one beds are much bigger than their twos and threes. And you're just seeing a general softness in leasing activity when it comes to one bedrooms versus twos and threes. And I think that logically makes sense, because if you think about a one bedroom is more expensive than a two and a three, because on a per bedroom
Price per foot too, for sure.
right, price per foot and a price per bedroom basis, right? You and a roommate can grab a two, and now you've really cut down on your living costs. So
It's like a third cheaper.
yeah, so I think that is definitely a dynamic that people are leaning into. And so with Gran Riviera, again, this is another nuance and another thing that you have to look into. And when you kind of go deep on an acquisition, is in this case, Gran Riviera has 70% of the unit mix comprised of 2 bedrooms and 3 bedrooms. And for us, this makes us feel extremely comfortable, because those sorts of units right now, we're seeing more leasing activity, number one, which is great. And number two, those are generally stickier tenants. So there's less turnover, generally speaking, with twos and threes versus one bedrooms or even studios, which would be considered the worst. So lower turnover and better leasing activity is exactly what we're looking for. I think it's pretty straightforward. The other, and you take that and you couple it with the fact that these are the biggest units in the submarket, that really wins me over and makes me really excited about the deal, because it's kind of like having a moat. It's kind of like having a Tiffany's signed paddock, right? It makes it more rare.
Is the bezel or the face Tiffany stamp? Because Drake said something very incorrect.
Yeah, Drake unfortunately has the money, but not the knowledge. So
correct. I'll take the money over the knowledge, for the record.
When it comes to having uniqueness in real estate or anything, right? Obviously, rarity is value. So if you have the largest floor plans in the submarket, that's a moat, that's unique value. People are going to gravitate towards that. And guess what? When it comes to new construction, people aren't building things like they used to. So the floor plans are more economical. So one of the benefits of an older asset like this is the larger floor plans. And I think this is just all interesting nuance that ties well together, because you received an email from one of our equity partners yesterday, and they just kind of flippantly looked at the deal and they said, oh, well, $145,000 per unit is too much to pay for a deal, a 70s vintage deal like this, right? And it's like, well, okay, $145,000 per unit sounds like a lot, but guess what? The units on average are over 1,100 square feet. These are massive units, over 70% twos and threes. Oh, and guess what? We're in Irving, right next to Las Colinas. So I think when I think there's almost a discount to be had when people don't understand the deal fully. We actually saw this on a deal. I'm trying to remember the dynamics of it, but it was a unique situation where basically it was such a trophy asset and it had such big units, but it was an older property. It's kind of similar to this, but it was in Houston, that the property traded for an above market cap rate because people couldn't wrap their minds around the price per unit. So the price per unit was high, but the cap rate was high, right? Which is kind of the opposite thing that you would think. And that's just a function of, because basically there was a ceiling on how much people could psychologically pay on a price per unit basis, which then essentially created a discount, because it technically should have traded for even more if you looked at it on a cap rate basis. So anyway,
this all goes back to being a market expert, though, quite frankly, and really knowing your numbers and knowing your market and knowing your territory. And, we do not liberally just buy deals in Dallas. I actually think, of all places, that we, are really cautious of, it is buying in Dallas, because everyone wants to be there. Therefore, it's beaten into the price. So for us to really feel comfortable and to find value in opportunities, that's what you look for people like us. Is we're looking to find value. Value can come in multiple forms. It could be, obviously, as I say, the 3 deals we buy, value-add deals, good basis there, deals at discounts like Cortland. And then, obviously your tax payment deals, like, what some of our opportunities have been in the past. But, you want to find value and kind of see what other people aren't seeing. And almost, to a certain extent, being contrarian, because that is the true alpha. And I think we kind of are to a certain extent in this opportunity, which does generally get me excited. Now, my work might be a little bit more difficult because some people traditionally might say no just because they read the first line that says 72 asset. And that's totally fine. But I'm telling you, this deal does not feel like a 72 deal. And then, going to the comparable, which, super important, right? You can make money buying any type of, asset, any type of investment if you buy right and buy well with a clear path to, creating value. So about a half a mile away, there's property that we use as a rent comp, which is about, $155 more expensive than ours, plus or minus, for renovated units. And this property is not more special or grandiose than ours. Signage, not better. Actually, how you turn into the property is a little bit awkward. So logistically speaking, it's kind of silly. But there's nothing, that's so, oh my gosh, we can't replace this and copy and paste that strategy into our property. Not to mention, we're going to have, higher, we should, match that, but we'll have a lower price per square foot metric going in from a rental perspective, which maybe we can kind of take advantage of on the back end there. So all that's to say, we really do feel like we found a diamond in the rough, and we're finding value where a lot of people are not necessarily looking right now. And I don't think that's necessarily a smart thing on a lot of people's end. And I also think there's our group and herd mentality too, as well, with kind of thinking. And, people get into this group set and group thinking mindset where, hey, I'd rather just not, buy something like this because I don't want to look silly, or maybe they have an opportunity cost issue here at hand. But all that's to say, we feel very, very optimistic about this opportunity, and this is certainly something that we are thrilled about. So I think at the moment there's still a little bit of space left for some capital raisers. So if you are a capital raiser, or if you're an investor, or you are a capital allocator of sorts, and you're looking to raise on a deal, to learn more, this is a 506C offerings. That's what we're talking about it here on this forum. Please let us know. Reach out to me, of course. And if you've got a 1031 exchange, make that commitment date by the 27th, which is Memorial Weekend. So this deal is 1031 exchange tick compliant and acceptable. So if you are interested in that, or if you have a need or know someone with a need, please let us know. We'd love to facilitate that.
Perfect.
Any other, any final thoughts that kind of maybe stood out to you while you're at the property, while we're kind of taking it in? I really actually did like the units. As I said, obviously it goes without saying, very spacious, but they are very spacious. Multiple pools, tired amenity sets, but as I said, it's a clear path.
It's a very straightforward deal. I think now's the time to be doing something like this. And like you said, it was really tough to make deals pencil in Dallas. Dallas is not for the faint of heart. It is potentially the best market in the country. I think there's some, you obviously have to pay a premium for that. So I think that's just the name of the game. And on the back end, there's going to be a lot of growth and a lot of demand and a lot of stability.
Yeah, and it's funny, as time goes on, not to, speak against this deal, but it makes me really appreciate Houston. And how great the numbers are in a lot of those deals there. And honestly, how great the first 3 deals, this inclusive, have been to start this year. Acquisition front's been great. And I just want to kind of say this, and I would love to talk to you about this as you are, study this obviously, and, I do as well, but you can kind of phrase it, put a nice bow on it. But just, being an investor right now and investing in today's market is truly the time, between now and the next couple of years is really going to be the best time to invest in value add opportunities. We had a kind of a very interesting conversation with that capital allocator, capital partner at lunch, just talking about, because they traditionally do more development opportunities, but right now is the time they're kind of reassessing their kind of thesis statement, their mission, kind of away from the development play and really actually more into value add because they see the value there. So can you kind of speak about that, what's going on, pertaining to, development, value add, maybe the lack of supply coming up, and why right now is the time to, deploy capital in the market?
Yeah, if you think it's tough to pencil deals for multifamily acquisitions, it's much, much harder for development. Developers are struggling with construction financing. They're struggling with construction costs continuing to rise, and they're struggling with staring into the face of weakening fundamentals. Now, weakening fundamentals, everyone agrees, is a temporary thing. The long-term tailwinds for multifamily is extremely strong. And just to recap them, there's a bias towards rentership from a cost perspective, as well as just from an affordability perspective, also from a cultural perspective. People are delaying the time that they typically buy a house. 34 used to be kind of the millennial sweet spot to buy your first house, and now it's kind of 39 is what actually the New Market Economist was just saying earlier today. So the consensus is that the demographics are really strong, and that long term it's going to do really well. But in the near term, as developers are looking at where rents are today and they're penciling deals out today, they're kind of stuck looking at, well, rents are down, my costs are up, and I can't get financed. So doing a development deal is really tough right now. And you have a lot of, and also let's not forget the other big part of it is cap rates are up. And so now you're looking at, when you finally build the deal, you're going to be selling it for a higher cap rate. So your development spread is less, and therefore your profit is less. And a lot of developers are looking at deals and looking at it and thinking, well, if it costs me $250 to build, and I can buy that same product today for $220, why wouldn't I just buy it? Right? I can buy below replacement cost, and I can just do that, right? So that dynamic is making it really hard for developers. And so some of those developers are pivoting and doing acquisitions, which unfortunately crowds the acquisition space and compresses cap rates there, which kind of rebalances everything, right? The market is cyclical, but things balance out over time, and construction costs are probably going to moderate, and then cap rates are probably going to recompress, and rents are going to come back, right? We need to get back to a functioning environment where the capital markets are functioning properly with a positive sloping yield curve, and that the fundamental market is also normal, where developers can build and then sell for in excess of replacement cost and make a profit and everything. So all these things are going to happen. But in the meantime, right now, it's such a challenge. Developers that can get stuff out of the ground and maybe perhaps do a deal with low leverage construction financing, or all cash perhaps, those are going to be really good deals, because if you're able to build today, you're going to deliver into 2026, and you're going to have no competition. 2026, there's going to be a dearth of supply, and into 27, and that's going to be a nice rebound and a good time for the rental market.
And what's going to be really interesting to see, and I'm making this prediction today, so in a decade's time, you can say, wow, Craig, you were so smart for that spot-on take. But from 2020 to 2025, there's going to be a lot of, call it in 20 years from now, really. There's going to be all these properties from 2020 to 2025 that were built, and there's going to be a ton of supply and vintage then, and then there's going to be absolutely nothing from 2025 to 2030. And then 2030 to 2035, there'll probably be a lot more supply coming on in that kind of range. But I mark my words, there's not going to be a lot of, development going on in that time period. But the beautiful thing is that probably around 2026 is when everything's been delivered and whatnot. Nationwide, obviously, and when rent growth should really start spiking up again, because there's not, a bunch of new supply, putting a downward pressure on, existing inventory rents.
Yeah. And similarly, right now, I think one of the smartest things that one could do would be to buy Class A core trophy location deals all cash.
No, the smartest thing someone could do would be invest with us.
It's true. That is very true. But if I were sitting on $100 million and I was super rich and needed to put out my capital, I would just go and buy trophy assets all cash, because that is, I think there's definitely a strong argument there because of the replacement cost argument, right? You're buying great basis, and right. Unfortunately, we're not in a position today to buy all cash. That's just,
well, according to everyone on TikTok, you have all the cash in the world and whatnot. So
I am. Nobody becomes a 27-year-old with a $600 million portfolio without daddy's money, right? So I guess maybe everyone online is right, and I do in fact have $100 million sitting around at home.
Rob, I thought you did. Come on.
Yeah. Well, maybe on this next deal, I'll just use that as my co-invest, and we'll be good to go.
Right. You'll just backfill the gap, solve for it any way necessary right there. Well, and I think it's just a really interesting conversation, just, comparing different markets and going through replacement cost metrics, things of that nature, just super kind of just in the nuts and bolts, the weeds of the business and the fundamentals that are really important, buying well, buying right, well-located assets. That's kind of the plan there. And, it's all about, I was having a conversation with our dear friend Teddy, just about risk-adjusted returns and, where it really does make sense to invest. And it's just an interesting kind of point in the market. I mean, the market's always fluid and dynamic and interesting naturally, but we're in such an interesting period of time right now where maybe there's a recession coming up. Who knows what it looks like? We have an election coming on. Rates are high. They're very volatile. It's very challenging to make deals pencil. But as our forecasting has been, as we've said on the show, it's very interesting to see a lot of deals that have been kind of locked up beforehand the last couple of months that are kind of popping out of contract because of this treasury run up. So we'd love to hear kind of your takes on, how people have been navigating that from your perspective. You're obviously at a brokerage event right now, so I'm sure the interest rate conversation has probably come up a couple of times. So I'd be curious to know maybe some of your thoughts pertaining to that.
Yeah, well, as you heard me say before, I'm reticent for us to be always talking economics on this show because we aren't economists, and just pontificating about the future, I think people are going to get sick of it, but I just can't help myself. And the market is just too interesting. It's a big puzzle. So I think it's so interesting that at the conference today, there was a poll where on the app you would put in, okay, and the question was, do you think we are at a peak cap rate? I think it was roughly the question. Basically, do you think cap rates are going to go lower or higher from here? And the majority of the room said, no, we are not at peak cap rates, and that cap rates are going to continue to expand. And while I would love that, and I would love the opportunity to buy deals at a cheaper price and a better cap rate, I have a hard time really buying it. And also, if you just think about it psychologically, if I was in a room earlier with Newmark's top clients and a bunch of brokers, these are optimists, right? Like I'm an introvert, right? And so I'm struggling here because I sit down and everyone's an extrovert, and it's like, hi, I'm director of acquisitions at XYZ, and these are hard charging directors of acquisitions that are like whatever, all that kind of they're optimists.
Elite folk.
Well, they're aggressive. My point is they're aggressive, and so they're going to be optimists, and they're going to think, oh yeah, we're at peak cap rates. Cap rates are going to compress. We're going to buy, right? Well, if you have a room like that that's naturally predisposed to optimism, and yet most of the room is pessimistic about the future, that actually paradoxically implies that we are at peak cap rates, because what's everybody doing at the conference? They're all sitting on the sidelines. And if they're sitting at the sidelines, that means that's capital that's not in the market. And when there's less capital in the market, that pushes cap rates higher, right? When the flood of capital comes back into the market, that's going to compress cap rates down. So I think it's a paradoxical thing that because the majority of the room believes that we haven't hit the bottom yet, that we kind of have hit the bottom. Now, I also can believe my other counter argument that kind of goes against this notion is I don't think that we're out of the woods. Newmark's chief economist today said that basically a lot of people are wondering about a hard landing, soft landing, no landing. And his argument was, we already had the soft landing. The soft landing already happened. And I think that's so wrong. I think the economic data shows that the future is not positive. I think that there's going to be a weakening of demand, and there's going to be a softening in the economy, which is going to cause incomes, NOIs at the property to go down. So that is how we can go lower price without actually a change in the cap rate, right? If NOIs actually get worse.
Yeah, and we've had that conversation before, maybe a week or 2 weeks ago, just pertaining to yields going down, but cap rates compressing, right? So kind of an interesting concept, slightly counterintuitive.
Cap rates compressing, not
or cap rates just not raising.
I'm saying cap rate can stay stable, but the NOI of the property can go down, and that's how you see a price decrease. So
yes,
I've been saying this for a while.
That's what I was trying to formulate that.
Peak cap rates don't necessarily have to coincide with the bottom in pricing, is what I'm saying. And I think that's the next step of this cycle here, is that we've already seen peak cap rates. I think cap rates peaked in December of 23 because I think that's when there was just no capital in the market, right? I think the number one driver of cap rates, number one determinant is not interest rates, but it's flow of funds. And in December of 2023, there was no funds in the market. And there was scarcity of debt capital and a scarcity of equity capital. So the next step in this cycle is actually a deterioration of NOI, which is something that we're very cognizant of, careful of, and that's why we want to be conservative when we're making our 2-year projections in our models.
That's exactly. I put some big beans into today. Went to the bank and wired over a big bag, a big allotment to Cortland Copperleaf, which is closing, I think, tomorrow. Which was a week ago from when you're listening to this, of course. But very excited about that one. And you want to be contrarian. I think if you want to make money, as they say, this is such a belabored and redundant term you've heard, but be fearful or be greedy when others are fearful, and be fearful when others are greedy. So now is the time, as I said earlier, to really put your equity to work. It's not going to feel good, but when everyone says it's a good time and you've already seen some gains, you're not too late, but you just didn't get it early enough. So don't expect to get outsized returns, crazier than usual. If you're not willing to do it right now, and very few people are wanting to put their capital to work in today's market. Another interesting conversation, as we're kind of in the theme of cap rates, is when we underwrite to cap rate compression and expansion. So I'd like for you to kind of speak on that kind of concept and premise there, and just kind of unpack that thought.
Yeah, this is a controversial topic, and I actually have been getting flamed on LinkedIn. I had a post kind of go viral because I basically spelled out our philosophy about cap rate compression today, and a lot of, all the tomato cans came out of the woodwork.
Wall Street Oasis, yeah, the thread's going crazy.
The tomato cans, the window lickers, were coming out. They were coming out in force, basically saying, you can't do that. That's aggressive. You're not smart. And I think that's really funny because it just exposes herd mentality. And it also speaks to the fact that, yes, if you guys are all thinking that you're going to put cap rate expansion into your model, you're going to sit on the sidelines and you're not going to buy. And then once the market actually starts running, then you're going to scramble and go, oh my gosh, now's the time. And you're going to jump in and you're going to be late. And that's almost to some extent. I can, by the way, I hear your keyboard banging away. So if you're gonna,
apologies. Yeah, I was just, my bad.
That's fine. Just go on mute when you're typing. What I was going to say is we're not market timers. So I'm not trying to say, oh, well, we're investing in this deal because we're making an explicit bet on interest rates, which people are making that argument. They're arguing that, oh, well, if you're going to bake cap rate compression into your model, you're basically speculating on interest rates. Well, newsflash, real estate is a levered asset, and you're always speculating on interest rates. You cannot invest in real estate without an investment, essentially, or a thesis on interest rates. So real estate is not divorced from interest rates, right? It's one of the most interest rate sensitive industries.
Well, all investing is, okay? Everything is tethered to that. It doesn't matter if you're in Bitcoin, if you're in the stock market, everything is, based off what, interest rates, treasuries, bonds, you name it. And also, the crazy thing to think about was, just last year, for any investor to really make a deal make sense, the deal had to really, outperform what, a risk-free return would look like. So that was kind of what the theme was last year is, hey, if I'm going to invest in this deal, how much better is this than a risk-free investment?
Yeah. So there's a lot of different ways to approach this. And I felt like the post I made was well defended as far as my beliefs, and also my beliefs aren't necessarily unique. There's a lot of other big, very thoughtful buyers, MG Properties to name one that I highly respect, and they're operating under this thesis as well. And the idea there is, if you're looking at where cap rates are today. Oh, also the point I wanted to also say is I don't want to hear people say, oh, well, I'm doing a value add deal. I'm forcing appreciation. So it doesn't matter what happens in the market, right? That is so not true. Whether you're buying a core plus deal or you're doing a value add deal where you're raising rent, like I don't care.
Oh, you did a value add deal, therefore you get different market economics and fundamentals.
Yeah, therefore what? You're not exposed to market risk, right?
Moron.
I don't care if you're raising rents. If your business plan is to raise rents $250, you are forcing appreciation, but that's very
you're forcing rent increases.
Yeah, that's right.
You are not forcing necessarily appreciation.
No.
Because if cap rates are at 8 all of a sudden in the marketplace, which is not really any market that we're in, But if all of a sudden cap rates are at 8 and you raise your rents $400, you probably lost money on that deal if you bought that cap rate at a 4. Okay.
Well, also the market is efficient, right? And so if a seller is sitting on an asset, let's say the seller bought the property 30 years ago and has never touched the interiors, and this seller is personally friends with every single tenant. So the seller is, allowing the tenants to have rent that's $800 when realistically the rent should be $1,200. Well, the seller's not an idiot, and nor is the broker that's representing the seller in the sale. So they're going to sell the property at a price that is baking in the upside that they know is there. The only time that you can really make money in a true alpha sense is when you're doing something that the seller doesn't know about. That's how you actually make money. Because if the seller knows...
Or have the ability to do something that very few can do.
Well, yeah, I mean, in effect, yes, that's right. So that's true alpha. So when someone is pitching a deal to you and they're saying, well, this is a great deal because we're raising rents by $250, you have to take a step back and ask the question, what is the yield on cost? At the end, that's the crux, that's the brass.
Well, that's what Josh asked. Josh, our friend, and hopefully soon to be capital partner, asked, what is the number one thing that you look for? And what you said without hesitation, it was yield on cost, untrended, trended. If you want to dive into that. Yeah, untrended. Yeah. What's the difference between trended and untrended for me and also the listeners?
Yeah. So a trended yield on cost is basically when you look at the year, let's say year 2 or year 3 yield on cost. So you basically look at your pro forma and you look at your year 3 NOI and you divide it by your purchase price and your renovation budget. And basically that would be your all-in cap rate in 3 years. And an untrended yield on cost would just take it wouldn't grow the rents over time. You wouldn't trend up your income into year 3. You would just look at, okay, what are my pro forma expenses right now? And where do I think I can push income? And then that's your NOI. That's your stabilized NOI that you haven't trended up yet. Obviously, because in an underwriting model, you're going to typically grow rents by 2-3% per year. And so even if you're growing expenses by 2-3% as well, that's still going to be a net positive to your NOI. So a year 3 trended NOI is going to be higher than just a untrended stabilized NOI.
Perfect. So back to what we were talking about before, what are instances we would underwrite cap rate compression? Because we talked about it as controversial, we didn't really get to the crux of it. What are situations in which we would underwrite to cap rate expansion and compression?
Yeah. So let's focus on compression because that's the soup of the day. That's kind of more relevant today. If you bought a deal at a really good basis, if you have high conviction that you're buying the deal for a great price, you shouldn't be penalized for that in your model. And what I mean by that is, let's say the property should have sold for a 5.5 cap, but for whatever reason, because some exclusive private reasons that we can maybe share in the future, hopefully after we close a certain deal. Anyway, I'm not sure what we can share or not, but because of private...
No, you know what? No. If you are secretly listening and don't know what we're doing here, this is your call to action. You'd be silly to not hear us out. And this is just a general statement. I'm sorry I'm stealing this and hijacking, but if you're not willing to have a conversation with us, we send you emails and whatnot, and you're looking to meet and whatnot, I think you're so silly. I think you're a very, very silly person. Sorry, I just had to get that out there.
You know what I think is more silly? And this is something that I've been oblivious to, and I think you pointed it out because you're looking at the situation with fresh eyes, but I've just been hustling and grinding since 20 on learning multifamily and building this business. And I never look at myself as a victim, and I'm not trying to play the victim card here, but what you've pointed out and what I've started to notice, and I think is true, is that people just discount us because we are young. And that I think is very silly. I'm obviously biased in that, but I think what's more silly than what you just said, which is, oh, well, if you've kind of been checking us out, but you haven't reached out to work with us, right? Because
I understand that. And they aren't the problem. Yeah.
We're not a fit for everybody, obviously.
Yeah.
And someone watching this...
Not everyone wants to buy, unique deals with tax abatements and buy really great deals and be really smart, sophisticated. Not everyone wants to make a lot of money. And if you don't want to make a lot of money, we're not the guy for you. Like, we understand if you want to give out charity elsewhere. Totally cool.
Here's what I get. I get if a fund has been investing with a sponsor for 20 years in Texas, and they're not just going to jump ship to us and now we're their Texas sponsor. I get it. Like, I'm not offended by that whatsoever. But what I think I am now ready to be offended by is the people that have known of us. We've talked shop with them. We've pitched them deals, and I'm talking about for years now, where they've seen us since I was 23 to now 4 years later, 27, and they're still just hanging around, still just watching. Like, to me, I'd think, what are you waiting for, and why?
And
You know,
and honestly, more important to me, actually, to that point, is what are you saying yes to? Like,
well,
what is so compelling where you wouldn't even just engage, entertain a conversation? And maybe we sound so conceited and arrogant right now. We have such inflated egos that we're crazy, but I don't think so. I really don't think so. I think I'm a very logical individual. Okay. And I think this is all very silly. It's all very silly to me.
I think you're acting hysterical. I think you're losing composure.
It's true.
So anyway, I think I wonder what people are going to think of this rant here. Basically, us being desperate, going, why don't people want to invest with us?
There's no desperation. Our deals are funded, and people are trying to raise money for our deals.
Sure.
So
That's true.
but
too.
it's just more of the fact that
Yeah, you and I take things very personally, I would say, and
Yeah.
I don't think that's necessarily a bad thing. We're very
it's like the
proud.
Michael Jordan meme, and I took it personally.
Yes, we're very proud of what we do and of what we offer, and we put our blood, sweat, and tears in this. I mean, Dasha, like, I can't, like, I almost feel guilty for how passionate our team is. You know what I mean? Like, because I'm the one that made you guys this crazy about multifamily.
Well, no, I've already kind of been a sociopath. Just like, I'm very competitive. So, this is my life. I don't have a life. I mean, I have my dear friends. You're obviously, my closest friend. I play a little golf here and there. I play a little pickleball, although I leave my paddle in New York here and there. I like to work out. I like to exercise. I like to talk with my friends on the phone, and I like to work. I don't care about really anything else. Nothing else is really that important.
So, anyway, that is an interesting rant. I forget how we even got to that subject.
Cap rate compression, where you expand, where you contract. Let's just let's put a bow on that.
Okay, all right. Let's hit this. So, if the market cap rate for a deal is 5.5, but you somehow, that's how we got derailed, is because I started talking about unique ways to create value, right? So let's say you have a deal that fell into your lap and it should have sold for 5.5, but you got it under control for 6. So what exit cap rate should you underwrite? Should you expand it by 50 bips from your entry cap, which is 6? So should you put a 6.5 cap exit on it? Should you put a 6 cap on it and just, expand off the 5.5? It's an art, much more an art than a science. But what I will say is, looking at your 6% entry cap, while it's relevant, it's not the end-all be-all, because what's actually more relevant is the prevailing cap rate for the market. So if it truly is a property that should trade for a 5.5, that's your baseline. And then from there, you need to work off of, okay, do I want to project a world in which 3 to 5 years from now, cap rates are stable and the same as today? Or do I think that they're going to be higher than today? Or do I think they're going to be lower than today? And that is, I know that now you're kind of embedding some personal house views, but here's the reality. You are looking at the deal holistically, on a cap rate basis, on a cash flow basis, on a yield on cost basis, on a price per unit, on a price per square foot. So there's a lot of metrics that make it all make sense. And kind of the last one, where you are just kind of looking to fit the pieces of the puzzle together, is your exit cap. All right, it's the least knowable, it's the furthest out in the future, it's the most speculative. So instead of stressing on all that, I'd rather stress on all of those things up front: basis, business plan, cash flow, right? Because if we get the cap rate wrong on exit, that hurts. But if we get the cash flow right, then we can enjoy the cash flow, and the cash flow can be very meaningful. And that's how you protect yourself against a downside scenario. So the point I'm trying to get at is, you actually just need to have a rational, defensible exit cap rate that makes your numbers look good. And in today's environment, I'm sorry, you're just not able to make the numbers look good with an overly conservative expansion scenario. That's just hold on, let me just say, that's just not what market consensus is. So if you want to be in the market you have to play by the market's rules.
Well, also the funnier thing I see is a lot of people who push back on that. It's like, okay, well, let me ask you something. What was the exit cap rate you did on every other deal you've done for the last 4 years? Because if you're going to scrutinize this deal at a cap rate here that's incredibly wide, well, then you just lost all of your money in every other deal you've done before. So I just find that to be just at a macro level, and this doesn't speak to everyone because there's some cautious general investors out there, but just at a by and large level, how does that make sense? Do you see what I'm saying there? Do you follow me?
Yeah, I mean, back when cap rates were at all-time lows and people were paying 3% caps in Phoenix and Dallas and four caps.
Carolinas and Tampa and you name it. Yeah.
Cap rates were 3 to 4, and that's not a stretch, right? When cap rates were that low, let's call it 3.5, because you had a value add, so you're paying a compressed. So also, if you look at the flip argument, when you buy a value add deal, you pay a compressed cap rate because you're going in low and then you're adding value to the property to raise the cap, and that's how you're getting above the market cap rate. So you're inherently buying a stabilized cap rate, or you're buying a compressed cap rate, and then the question is, okay, well, where do you underwrite your exit? So back when cap rates were 3.5, people were underwriting a 4.5 exit cap rate and going, well, look at me, look how conservative I am. I'm underwriting 100 basis points of expansion. And so the deal checked that box. You could look at the deal and kind of squint and turn your head and go, okay, yes, you are underwriting 100 basis points of expansion. That's maybe not exactly correct, but that's true. But if you analyze the other aspects of the deal, such as the yield on cost or the cash flow, it wouldn't necessarily, or the basis, discount to replacement cost or lack thereof, right? The premium, it wouldn't necessarily look as good as today, right? So, and then to your point, which you made so passionately, is if you look back at your old deals and you were underwriting a 4.5 exit cap and you felt really good about that, that was the one part of the deal that checked the box and said, yeah, I'm underwriting 100 bips of expansion. Well, you'd have to be pretty aggressive to underwrite a 4.5 cap exit in today's market, right? So what felt good before, now people turn their nose up at and go, no, that's crazy talk. And I agree. I mean, 4.5 is very low. We haven't underwritten a 4.5 cap by any stretch, right? We underwrote a 6 on a deal. This year we underwrote, I think, 6.25, and now 5.5 because that's Dallas, and Dallas is very tight. So yeah, that's a very good point that I'm not sure everyone's going to pick up on, and if they do pick up on, they're just gonna kind of
brush it under the rug and swipe it under the couch and kick the can down the road, and that's fine. Very interesting too, actually, in the subject. We got to wrap it up here, so this will be kind of one of the final thoughts here. But the thought is, I've gotten a lot of people who are starting to get in the investment space, which is so great, and they're just very just passionate and curious about multifamily, and they send me a lot of deals. And I've gotten a lot of deals sent to me with exit cap rates that are just, oh, well, because we did value add deals, as you alluded to, we get a compressed cap rate. But actually, typically speaking, there's not really that much juice to be squeezed out of it. So typically speaking, there might be, a par cap rate on the exit, or, and obviously it's a nuanced situation, at a par or, slightly higher. Like we think we're underwriting a slight cap rate expansion, really pretty par, because we think, yeah, on this deal, we think this is a wider than normal cap rate due to the market condition, but we are banking on and assuming in our assumptions that the market will be better in 3 years than it is today, which is a very, I think, natural thought to be in. But at any rate, they're sending me deals where the exit cap is, not at par, and these are fully, developed and landed deals. And it's like, okay, well, no one has cap rates that sell at this number. That's not realistic. You're resetting the market if that's the case. So if that deal sells there, well, that's a good deal. But every other deal in the market will have the same basically cap rate, give or take maybe a couple basis points here, there maybe a quarter basis point. So it just goes to show that, cap rates, as you mentioned and very well pointed, or what well stated, is that cap rates are very, very speculative and are fluid, but control what you can control, which is the location you buy in, the business plan you subscribe to, and the location of the property. Those are three things that you can kind of really wrap your hands around. And well, basis, location, and business plan.
Financing, yes.
Yeah, financing, correct. Yeah. Awesome. Well, once more, Gran Riviera is live. If you're a capital allocator or an LP looking to invest the deal, if you have a 1031 exchange, please reach out to myself. There's still a bit of space left for capital partners to come in on this opportunity. If you're an LP looking to learn more, you know the email, but once more, it's craig@lsre.com. Any final thoughts you got here, Rob, before we depart from this podcast?
No, I think this was an interesting show. And
Animated.
Yes, animated, passionate, and I look forward to doing the next one.
Well, everyone who's on the show, thank you so much for being here. We look forward to catching you soon. Thank you so much for tuning in, and we'll see you next week. Peace.